Happy Monday and welcome to Money Matters episode 4. Busy week this week, lots of macro around, and quite a number of big earnings to come. So let's delve in. We've got the Fed are announcing their rate setting exercise this week on Wednesday. It's unlikely that they're going to be changing their interest rates at this juncture. The market is expecting a further 100 basis points of cut. That would make it down to 3.3% in the middle of the range. This is pretty unlikely. We will have had, if that were to occur, some 200 basis points of cut over the last 2 years. The only times that's ever happened has been when we've had a recession. We've also had an agreement over the weekend on tariffs between the US and the EU, struck at 15%. We've now got it out of the way. It's pretty much done with its main partners, including Japan, India, European Union, some parts of South America and the UK. So all good there. We've also got the US core PCE. Now, this is the inflation number that the Fed takes account of. The latest number is expected to be around 2.7%. I think that the probability at this juncture is that it's going to be on the up. We've also got unemployment data for the US coming through on Friday. The unemployment rate is at near full employment, which means that the economy is ticking over at a very nice pace. We've got the ISM manufacturing, which is just at contraction phase, something we need to be aware of. In terms of outside of the US, we've got inflation numbers coming through on Wednesday from the Eurozone. Current numbers are at 2.4%. We've also got unemployment rate in the European Union, which is currently running at 6.3%, which is not at full employment and speaks of the issues around the sclerotic element around the labor market in the European Union. This is why, in my opinion, it is always going to underperform the US economy, which has a much more open market and a lot less regulation. So what's happening in corporate corner? We've got 80% of earnings now being announced. With that, we've seen some 4.5% increase in earnings this year for the S&P 500, which is a pretty good clip. We've got a number of earnings, particularly large Mag 7 earnings coming through this week. On Wednesday after market, we're going to see Microsoft, Meta, and Qualcomm. For Microsoft, we've already got some early stage heads up from Google's numbers, which suggested that the data cloud storage market is doing pretty well. We've got Visa and MasterCard reporting this week. We'll come back to that in Thought for the Day. And other notable include Apple and Amazon after market on Thursday. Apple, a tale of two cities. On the one hand, their service income is growing and doing very well through their apps. The other is that the replacement cycle is getting longer and longer. It used to be around 2 to 3 years. It's now stretching towards its 4th year. And I suspect that this will continue as the underlying cost of the physical unit of a smartphone is going up. But at the same time, the features are not particularly revolutionary. And so we should likely see the numbers for smartphones units pretty much trail expectations, not a particularly optimistic scenario set for Apple. On the other hand, Amazon has underperformed to some extent its Mag 7 peers, not as much as Google or Tesla, but it's certainly not outshone the bigger names, including Meta and Nvidia. And I think that Amazon's issue has been that the reliance on its merchant market has meant that its revenues have grown relatively slowly and its margins are relatively thin compared to its compatriots. However, it looks like that the company has been incredibly adept at growing its advertising segment, clearly has an incredible knowledge of its customer base and their habits. And AI has played a significant role in optimizing those advertising opportunities. So expect strong growth in their advertising revenues. And of course, they are the leaders in terms of data storage in the form of AWS, which will probably grow less than Azure's and Google's platforms because it is the leading player and they are capturing some market share. So let's turn to thought for the day. Stablecoins and the impact on the credit card processing players, MasterCard and Visa. MasterCard and Visa have traditionally played a significant role in our portfolio allocation. They are the classic structural growth companies. They account for pretty much almost all of the credit card and debit card market. They are a classic duopoly. Will stablecoins come and disrupt this duopoly? First matter is, what is a stablecoin? Well, stablecoin is a form of cryptocurrency, but unlike Bitcoin and Ethereum and others, they are backed by fiat currency. Fiat currency are the currencies of the world, including US dollar, euro, yen, etc. And the one unit of a stable coin, in theory, should equal a dollar if a dollar issuer has issued it. The difference is, of course, that it is based and lives on the blockchain. That means that when you come to settling, instantaneous or virtually instantaneous in terms of fees, very low, and so can revolutionize the money markets in the same way that fiat currency revolutionized the money markets in the last 300 years or so. That spells doom, potentially, you say, for Visa and MasterCard, who dominate this transfer of monies between consumer, merchant, and the banking sector. Not so fast. Let's look at stablecoins opportunities right now. More than likely, they will be the biggest part of the market in the form of US dollar and euro. The banks are likely to be the biggest issuers of stablecoins. We don't know how the clearing process is going to work between JP Morgan stablecoins and Bank of America stablecoins. So that's one element of doubt that still remains out there. Another key part of this is that, of course, when you look at the process of the transfers, these are instantaneous. There is no credit element to these transfers. And of course, Visa and MasterCard, whilst they don't split out their credit card and debit card revenues, certainly rely a lot on the credit card element of their card issuance in terms of their business model. So that means, of course, that the credit card part of their business is safe. It doesn't get affected by stablecoins. The other element is, of course, on the international part of their business. Now, for Visa, international is about 25% of revenues. For MasterCard, it's about 35%, so significantly higher. And again, stable coins can make those transfers significantly cheaper, so margin erosion potential for MasterCard and Visa, more MasterCard than Visa in this scenario. Having said that, MasterCard and Visa have a number of advantages. They have a huge network effect. Virtually every merchant on the globe uses either one or the other. There's a huge brand identity, and it's very difficult to dislodge consumers from that brand identity. There's been talk of Walmart and Costco issuing their own stablecoins, a consumer depositing X amount of money into their account in Walmart and then being issued with stablecoins, which they can then spend on goods and services. But why would a consumer deposit an amount of money into their wallet at Walmart when they could pay with a credit card or debit. So I can't see the reason yet why the MasterCard and Visa model is going to get broken by the introduction of stable coins. And I would say that given the 70% margins that reside at Visa and 60% margins that reside at MasterCard, these players are likely to start to think very hard about issuing their own crypto credit cards and debit cards. They're likely to integrate stable coins into their model as well. So they're not out of the game. We are potentially likely to see those margins erode somewhat, but their revenue position is unlikely to be deterred. And I think that they both still remain core investments in a structural growth portfolio. The reason, by the way, why we're talking about stable coins now is a couple of weeks ago, the US passed into law the Genius Act, which allows for stable coins to be issued by entities. And this has started a doubting process for both Visa and MasterCard. And I think this creates a great opportunity to invest. So to conclude, we've had tariff agreements with the main neighbors in the world. So that becomes a non-story and I think falls away from the headlines. We've got major earnings coming through this week from the Big Mac 7, which on the whole are likely to guide better. There is a huge roster of economic news flow, but the result is that most G7 or developed economies are purring along, good growth, relatively low inflation, potentially ticking up because of the tariff effects, unemployment rates at historically low levels, interest rates staying stable. If they fall, they could in fact generate inflationary pressures, which we don't expect to happen.